But we're in a world where the confidence in international currencies is declining. The desire of central banks to have more gold in their reserves is, and it's a desire, they can't always do it, but it's a desire to hold more gold is there. Part of that will be accomplished through a higher gold price, and part of it will be accomplished by buying physical gold and putting it into their reserves. That's not going to go away, and investor demand is most definitely there. Any wobble in the stock market will have people thinking, shouldn't I have gold in my portfolio?
If you just look at the prior two bull markets in gold, that'd be from the 76 low to the 1980 high, or the 2001 to the 2011 high, they were both 8-fold gains in price. Right now, gold is at a 4-fold gain since its last bear market low, which is 1,050. So we're up 4 times.
Elevated oil prices continue to drive inflation fears higher, forcing markets to price out rate cuts this year, which is taking its toll on gold prices. However, one bank continues to expect prices to be much higher a year from now. In their latest note, commodity analysts at Bank of America said that gold could continue to struggle in the near term, but they are maintaining their long-term bullish forecast. The bank said it is maintaining its 12-month $6,000 price target for gold. Renowned precious metals analyst Clive Thompson and momentum-based technical strategist Michaeloliver offer contrarian views on the precious metals. In this video, Clive Thompson explains that gold and silver play distinct but complementary roles in the financial system. Reflecting on fundamentals, he points out that the gold to silver ratio is currently much higher than historical norms, which suggests that silver may have significant upside potential. According to him, even if gold remains relatively stable, a return to historical ratios would require silver prices to rise substantially, potentially outperforming gold in the process. In his analysis, Thompson further predicts that gold is likely to move higher over time, with periods of volatility along the way. He emphasizes that declining confidence in global currencies and rising demand from central banks are key drivers supporting gold's long-term outlook. In his view, investor allocation to gold is still relatively low compared to historical levels, leaving room for increased participation in the future. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Clive Thompson and Michaeloliver's recent interview.
So gold is purely a monetary asset and a wealth preserver. Silver is both industrial and monetary. And of course, if we go back in time to before the 1930s, silver was part of the coinage in every country. It had an intrinsic value because it was a rare metal. So it's every bit a monetary resource. Now, if we go back in history, the gold to silver ratio was much lower than it is today. That means to say you needed less silver than you do today to buy an ounce of gold. What that implies is that let's assume that gold it's not going to go down much. I mean, a possibility of below 4,000 is possible, but I don't think it's going to go anywhere back to the figures we saw a couple of years ago. So that basically implies that if silver was to go back to its old ratios, the silver price has to rise a lot to get to the old ratios, even if gold stands still. And I don't think gold will stand still. So coming back to gold, like we've seen with silver, we had this huge spike up to 5,500 nearly, and we're now nearly $1,000 below that. So it will take time of ups and downs before it goes past the all-time high. I think there's a good chance we will do that this year, but I don't think it's going to be a straight line. It's definitely going to be we're going to have days where people are going to say, oh, Clive Thompson, who was recommending gold, look at it's down today. And then 6 months later, I thank God I followed Clive because it went up. Now, I'm not making investment advice. I'm just telling you what I think. But we're in a world where the confidence in international currencies is declining. The desire of central banks to have more gold in their reserves is, and it's a desire, they can't always do it, but it's a desire to hold more gold is there. Part of that will be accomplished through a higher gold price, and part of it will be accomplished by buying physical gold and putting it into their reserves. That's not going to go away, and investor demand is most definitely there. Any wobble in the stock market will have people thinking, should I have gold in my portfolio? I mean, mathematically, it's not now been proven, it's been known, but it's proven that if you had gold in your portfolio over the last 5 or 10 years, it would have reduced your portfolio volatility, and depending on when you bought it, but at most time, almost every time, would have increased your return. So from a portfolio asset allocation point of view, it makes sense. Now, many funds cannot buy gold because that's not their mandate. The mandate is to hold equities or a 60-40 portfolio. But there's plenty of money out there which could buy gold. And I think it's only a question of time before gold starts to creep back into portfolios a bit more. We've already got quite a number of investment banks bringing out bullish forecasts for gold. But to what extent it's actually finding its way into the portfolios, it's a very slow process. It's nowhere near the 5%, which was traditional when I came to Switzerland in 1985. I'm guessing it's 1 to 2%, maybe even less than 1% at the moment. But in my opinion, there's a long way for it to go in terms of portfolio allocation. And I would use this period of relatively low prices for those who want to stack physical gold to go along to the coin shops and see what they can buy. Well, to tell the truth, I've never seen any evidence that in the short run, a war pushes up gold. Now, of course, that could have been the case in earlier years, but then we're on a fixed gold standard, so it didn't make any difference. So I've not really seen evidence. I mean, let's take as an example the Russian invasion of Ukraine. Gold went down when that happened. I think it was about 1800. It went down to around 1600, something like that, and stayed down for more than 6 months before it took off. So in my opinion, people, when there's a war, yes, they do respond to uncertainty, but the natural reaction in the early stages is to rush into things like the US dollar, rush into other assets first, and gold is more of a second thought as things become, as the war becomes normalized or it starts to fade away. I think gold is not responding to wars because people don't feel the need to have it in their pockets to run away from an invasion. People rather would like to hold dollars. If they're running away from an invasion today, they'd like to hold dollars. But what they do react to, this is the alternative, they react to a distrust in the currency. So as we print dollars to finance a war, that creates a greater supply of dollars or whatever currency is being printed. And we're in a printing spree around the world. We've seen the central bank expand the money supply. M2 money supply is rising rapidly in the last year or two. We've seen government debts, not because of the war, but generally rising rapidly. But of course, increased military spending, which we're seeing in Europe and the USA and everywhere else on the planet, increased military spending means that government debt has to increase. And as government debt increases, the confidence of people to hold it reduces. So I think we'll get to a situation where people will, not because of the war, but because the government debt is increasing, because the amount of money on the planet is increasing, they'll start to say, I need to have an allocation to something which is going to hold its value and protect me against whatever's coming with the currency.
In this interview, Michaeloliver argues that the recent volatility in the precious metals market is not a price peak, but rather a violent congestion zone that will soon resolve to the upside. He emphasizes that while short-term technical indicators like the 50-day moving average are being broken, the long-term annual momentum remains firmly intact. The actual monthly price changes have been relatively minor, suggesting a shakeout where institutional buyers are gobbling up silver and gold after running out stops. Looking ahead, Oliver predicts that gold is on track for a significant expansion that could mirror past bull markets. He points out that the 1976, 1980, and 2001-2011 cycles both saw 8-fold price gains, and since gold is currently only at a 4-fold gain from its last major low, an $8,000 price target would simply represent history repeating itself a third time. However, JP Morgan report projecting a $9,200 target as evidence of broader institutional alignment. The market is very near the end of this sideways congestion and expects a breakout within the coming days or weeks that will be extremely volatile and far more explosive than the price action seen over the last year. Let's jump into the interview.
Violent congestion zone, and I think it is not a top. Our assessment is, first off, when we run long-term momentum of gold, factors that got us bullish. In fact, we turned major bullish on gold in February of 2016 at a price of $1,140. And that was based on annual momentum, very long-term metric. You could have big up and downs inside that context of an uptrend. And this drop, even though it looks severe, did not dent in any way the long-term momentum trend of gold. Yes, it did break short-term things. In this case, you're looking at, let's say, a 10-week average, for example. You can see that red line on the price chart. You tended to hug it. Actually, if you go back and look over the last couple of years, it's been below it a couple times, so it really hasn't respected it that much. But you clearly broke below it in March, once the war began, okay? Opposite to all the stupid wisdom about gold goes up because of global uncertainty. No, it doesn't. That's not what drives gold. What drives gold is the ongoing degradation in the money units. Okay. Anyway, but since then, I don't have it in this report, but if you simply go to your quote screen, any of your watchers, and punch up a monthly price chart of gold, go back to 2011, preferably, the peak when we were 1920, and look at the monthly bars and look at what's happened since, especially the surge since 2024, which is really our last major buy signal in March of 2024. That's when it was pushing up. You don't even see it here. It was pushing above 2,000. It's the violence that we've seen since the January spike peak has been really sideways. In fact, right now, after this month's over, what do you think gold is? Okay, we've closed for the month, settled. Okay, gold's down about $10 on the month. Would you think that? Okay, and silver's down about $1 on the month. You'd think, oh my gosh, it's got to be worse than that. No, it's not. The miners are down like 1% on the month, and when you plot a monthly close for the last 4 months, it's like boop, 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 boop. It's like a beehive of noise, and the bears think every time it drops, oh boy, see, I'm right, and the bulls are sweating constantly. Actually, it is just a violent congestion zone, and I think we're going much, much higher. And we've said in many prior interviews and reports, if you just look at the prior two bull markets in gold, that'd be from the 76 low to the 1980 high, or the 2001 to the 2011 high, they were both 8-fold gains in price. Right now, gold is at a 4-fold gain since its last bear market low, which is 1,050. So we're up 4 times. So we're only half as much up in terms of expansion in the price of gold as we were in the 2 prior bull markets under far less onerous conditions back then than we have now. So to project something like $8,000 gold is merely to say gold's going to do it again a 3rd time. And in fact, I think J.P. Morgan came out with a report in the last month that projected a target of 9,200 based on other reasons than ours. And frankly, 8,000 is not our target. It's just noting what gold has done in the past. And I think this violence you're seeing right now is merely a violent congestion zone. And I think we're about to come out of it. And when we do, what's on the other side of this congestion zone should be extremely volatile and upside, more so than what we've seen in the last year or two. If we plotted a 50-day average oscillator, you'd see something like this. Although, frankly, the 50-day has not been respected that much. You've actually dropped below it a couple times in a couple of years, but around that level. For instance, look at this oscillator here. You could see that what we've done in the since the spike low that occurred in March, and that's when gold went down and swept its February low. And everybody thought, oh my God, it's the end of the world. Okay. And you stayed down there for about 2 days. And gold exploded back up into the 45, 46, 47, 4,800 after taking out that 44.23 low of February. And silver did the same thing. It had a low in February and it blew it out. And if you look at a daily chart of silver, go back and look at where the Feb low was and where the low was that we just made in March 23rd, it was at around $61. You stayed below the February low a couple hours, whereas you blew it out, ran all the stops. Somebody came in and gobbled it up because silver went from the low 60s back up to 80 again. And what we're trying to monitor right now is not the major trend of gold. It's up. It's no issue. This is congestion. Is when do we time, at what price levels does momentum say, okay, I'm really coming out of this congestion zone and I'm going to blow your head off? I think we're very near that, and I suspect you're going to see it possibly in the next couple of days, especially as we get a week or two into next month. I think you'll see the evidence that this was a congestion zone.
Despite volatility and market noise, the combination of strong macro fundamentals, central bank demand, and technical momentum continues to support the case for a powerful move higher in both gold and silver. Driven by persistent inflation, geopolitical tensions, and strong central bank accumulation, gold is viewed as a key safe haven asset, with long-term predictions suggesting a climb toward $10,000 by 2030. The latest Kitco News weekly gold survey showed half of Wall Street and Main Street believing that gold could post renewed gains next week, with another third expecting further declines. With institutional accumulation increasing and historical patterns pointing toward a potential breakout, are current market fluctuations the last opportunity before gold and silver enter a significantly higher price cycle? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.